Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us the results of the U.S. election skyrocketed the stock market. However, he warns such dramatic climbs can also be followed by drastic drops. Ross takes a look at gold, oil, and the U.S. and Canadian dollars. Recently retired longtime BC broker Victor Adair gives us his take on what the election of President Trump could mean to the stock markets. While the U.S. and Canadian stock markets went higher, European and Asian markets dropped. He tells us why he thinks the U.S. dollar is climbing while the Canuck buck is taking it on the chin. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, joins us from San Diego to chat about the state of U.S. and Californian real estate and why Fed rate cuts are not helping home buyers. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Pleasure to be with you, Jim.
Well, how would you describe what happened to the stock markets this week?
Would you say explosive? Yes. For the last month and a half, we've been kind of sitting back here and saying, we want to see a good oversold condition sometime in October, November, so that we get an attractive buying entry position with a reasonably tight stop. And, a week ago, as the market started to ease off for about the eighth or ninth day in a row, the VIX rose up to in the mid-20s, the volatility index. And then as of Monday and Tuesday, the VIX stayed up as the market went into oversold condition. Finally, as I say, on November 1st and on November 4th, we got the oversold signals we were looking for. And since then, as you say, it's been a move to all-time highs. We had the Dow was up 1,200 points one day, follow through after that. You've got all of these indices, pretty much the major ones, at all-time highs. And the VIX, as I mentioned, it dropped significantly. And if we look back, last 20 years or so, there's been 24 instances where the VIX has dropped this much, the rate of change over 2 days. And in all but 4 of those instances, the market not only moved significantly higher the first couple of days, as we've seen on Tuesday or Wednesday and Thursday, but then it continued higher at a lessening pace for the next week or so. And that looks to be what we've got set up here right now. So strength here, maybe a small pause and correction over the next couple of weeks. But overall, we have just now started, as of the 1st of November, what's historically the best 2 months of the year. So you want to play the trend as long as it stays in motion. Clearly, you want to be looking for the leadership to continue. You've got the bank stocks, the industrials, consumer discretionary, the AI stocks all coming to life here. Cybersecurity stocks, which have really, I think, have got to be a real core item for a lot of people. All of those have ETFs so that you can participate in the broad sector move rather than having to find the individual stocks. But truly, it looks like the anxiety going into the election is behind us. You got a lot of people and money managers who are probably underweighted as of Wednesday. and they've got a fair amount of money that they need to spend just so that they look good when we finally get into the end of the calendar quarter. One of the items we want to watch for when you get breakouts like this and you've had such a surge in the volatility from a high level then back down and then the turn is that 4 instances, say dating back to 2000, had what we would call false breakouts, which then became rolling tops, and the market breaks have been significant. The smallest one was 12%, and the big ones were in 2000 and in 2007 at those tops. And as we know, markets dropped by 40 to 50% in the next 6 to 12 months. So for all that there's good excitement on the upside right now, the enthusiasm is there, consumer sentiment is high, but remember, consumer sentiment really goes with the stock market. When the markets are strong, everybody's happy, and if we run out of steam at some point, maybe that's into January, which typically is the tail end of the good part of the run. One wants to become fairly wary of things. So for now, I would say that the lows we put in at the beginning of this week, which were a test of the 50-day moving average on the S&P, that low is a must-hold position. You don't want to risk anything in the way of a leveraged position or anything in an account that might have vulnerability if we were to break that. But for now, ride the trend to the upside, and let's see how far it goes.
What's going on with gold?
So with the election, you ended up with a lot of volatility in the first 48 hours. The precious metals took it on the nose. A really hard day there. On Wednesday, we broke from 2,700 down to 2,650, and the silver, the same type of action there. And it was with strength in the U.S. dollar. The money clearly pouring into the dollar. The dollar ended up with a big up day Wednesday, pulled back Thursday, and then Friday steadied once again to the upside. The dollar looks as though on the short-term cycles, the 58-day one that we look at, that one has if it had sort of a right-hand translation to it. The high coming off the August low was anticipated then to take us up through the better part of middle of September and then a correction. Well, the rally to the upside went a little bit longer than just a standard cycle move would expect. So that right-hand translation and then the correction down just shows a positive bias here. So if we put in our short-term cycle low for the dollar index, you could see it being reasonably strong as we move right into the tail end of the year. With that, it's going to have put pressure on the commodities that you look at priced in the dollar. So that would be the precious metals, and if anything, you take a look at where the potential support areas might be for the gold market. We did this week get down to the 50-day moving average on Wednesday, got a little bit oversold, and you would have expected that a good bounce would have retraced more than 50% of the break, and all we did was get 50% and didn't have any follow-through on Friday. So if anything, gold's looking a little bit tired right now. A deeper correction down under 2,600, and we're at 2,685 right now. But a deeper correction under 2,600 would not be at all surprising.
What's happening with crude oil?
Crude oil had it rallied up for about 10 days from 67 up to 72.5. This is all within the confines of what I think continues to be a downtrend here. The closed off the week at 70.25. The trend is still down. The seasonals are still down. So there's no reason to think that we couldn't be, pushing well into the low 60s. And if they're going to be, easing up on restrictions as far as oil and gas are concerned in the States, and and the pumping is going to continue at high rates, it's going to put pressure on it. It would really take a strengthening economy to pull the market up. So for now, let's see if we can get our seasonal low in place somewhere into December, and then look for a reversal to the upside as we move through January into February. And we'll be patient, looking for a potential low. And at this point, there's nothing there to become excited about. You look at something like the natural gas, we're around 270 on natural gas prices, and that one is getting to the tail end of its upward seasonal. The market tends to be high ahead going into the winter, and then if anything does come off as you move through the winter. I would say that barring any real freezing temperatures in North America, that you'd be looking for lower prices there.
What's the tail with the Canadian dollar?
Canadian, we got some extremely significant oversold conditions on the dollar there, and I think clearly you're into an area which now should consolidate. We looked back and sent out some examples for the subscribers to look at. We are probably into a consolidation phase that could last a good part of 6 to 8 weeks here. Top end resistance is going to be up around the 50-day moving average. We're looking at a Bollinger Band underneath us. Probably gets tested, I would say, late this month or into December. And if commodity, if the oil market is going to stay under pressure for a while, I think the Canadian will continue to stay down. And, if the U.S. dollar is going to be strong, it's tough for Canada. And, all the rhetoric about what to expect now coming out of the Trump administration regarding tariffs and the push for the strengthening U.S. Economy from Trump, I think Canada's going to have quite a bit of trouble here, and I wouldn't be holding my breath.
Ross, thank you so much for chatting with us.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but still very active in the markets. His website, VictorAdair.ca. He's speaking to us from Parksville on Vancouver Island. Welcome back to This Week in Money.
Always a pleasure to talk with you, Jim.
Before discussing individual markets, happy birthday.
Well, thank you kindly.
So what are your thoughts on the U.S. election?
How much time have we got, Jimmy? No, I'll be short and sweet. I mean, it's been a long week. It's been a kind of a wild week in terms of market action, and my sleep cycle is definitely not normal. I was up a good part of the night on Tuesday. I mean, you just got opportunities you'd never otherwise see. Okay, clearly Trump won, and won bigger and stronger and all that than probably most of the polls were imagining. And there was reactions all over the place in the markets. One thing that happened across all markets was that volatility had ramped up in the markets before the election, and almost as soon as we started to get an idea that Trump was doing much better than expected, volatility just collapsed. So when I say volatility, I'm talking about the options market, whether it's options on stocks or interest rate markets, or it's gold, or certainly in the currency markets. But the market had really no idea what was going to happen in the election. And once it looked like, okay, we think we can see what's going to happen, the volatility just dropped off as the uncertainty left the market. So that was, and I'm not going to talk about, who should have won the election and why they didn't do this and didn't do that. I mean, I don't know. I've probably read 36 postmortems here already, and I'm tired of it. As a trader, I just focus on, so what's going to happen now? So the election was this big unknown in the future. Now it's behind us, and now we'll move on to different things, and it will be a different kind of market, obviously, now that that's over. But you just asked me my general thoughts. I mean, that was probably the one thing that was common across all the different markets.
Well, the U.S. stock market's gone straight up since the election. Why is that? Because is there usually enthusiasm after an election, especially when you have a pro-business president?
Yeah, I think there's a number of things. Let's do a little history here. In the month of October, the leading stock indices in the United States actually closed red. That is, they closed below the previous month's close. And part of that was people maybe de-risking or taking a little money off the table, however you want to say it, ahead of the uncertainty of the election. And then as we came in here on Tuesday morning, and right off the opening bell, the market started to get bid. That's the stock market. The currency markets and the credit markets were different. The stock market started to get bid first thing Tuesday morning, and I guess just in general kind of terms, the Dow, everybody follows that and somewhere, the Dow Jones Industrial Average was up about 2,500 points from where it had closed Monday night to where it closed Friday night. And now, in percentage terms, that's about 5%. So that was a new all-time high, as we've had new all-time highs in the S&P and the NASDAQ, but not in the Russell. Interestingly enough, I could just have a little segue here. Some of the overseas markets were totally different. European markets were down, Japanese markets down, Mexican market down. The Canadian market, the Toronto market, had made an all-time high in the middle of September. Again, like the American markets, kind of de-risking going into the election, then popped higher on the election, but didn't get anywhere near the all-time highs made last October. And they closed. Friday was a down day in Toronto. So the American markets, why? First of all, seasonality is strong, whether it's a presidential election year or any year. Some of the best gains of the year over the past, call it 20 years or so, on average, come in November, December. And then a month from now, we'll be calling it the Santa Claus rally, if it's still going. Another factor was corporate buybacks. I mean, this is some of the analysts will tell you, and I wouldn't dispute this, I don't know for sure, that corporate buybacks are the biggest bid in the market. This year in the American markets, the total corporate buybacks will be just shy of $1 trillion. And I see Goldman Sachs is forecasting over $1 trillion in corporate buybacks next year. The stock prices are going up as earnings are going up. Not only earnings expectations, but actually, yeah, we've done it, kind of the proven earnings. They've been rising. And then the multiples on the earnings, the PE ratio, has been expanding. The market's in a bullish mood. Nobody wants to be a seller, so we're going up. In terms of Trump, the promise, or the prospect, I should say, of lower taxes in the future, less regulation, get Musk in there with a broom. When Musk took over X, as he calls it now, Twitter, I think they laid off something like 80% of the people that worked there because they weren't doing anything, I guess. So, you let Musk loose in terms of maybe cutting the number of people who are working for the government. Now, he's been polite about it, by the way. He says, we'll give these people 2 years to find another job or something, but, we got to get that sorted out. So, in a way, and, don't blame me for saying this, but it's kind of like it doesn't get any better than this. The market's just, there's just no negative news anywhere other than possibly if the government is spending money like there's no tomorrow, really aggressive fiscal stimulus, interest rates may go higher, and rising interest rates might take a little wind out of the sails. But the market's in a very bullish frame of mind, and those are sort of the reasons.
Since the Fed started cutting rates in mid-September, U.S. interest rates have sharply risen. Why is that?
It's kind of a conundrum, right? I mean, back in September, the Fed, for the first time when did they start raising rates? In the spring of 22, I guess. So, they'd gone 2 years, and leading up to September, the market had for about a year been kind of hoping with their fingers crossed that the Fed would start cutting rates, and that was going to be, as I called it on this show many times, the green light special. Once the Fed starts cutting rates, baby, you buy with both hands. The Fed kind of said, well, we'd raised rates because inflation was a problem. We think we kind of got inflation under control. Now, that's me paraphrasing. Of course, they were much more polite about it. And now, the economy, I should say then, mid-September, the economy looked like maybe it was softening a bit. Some of the employment data in particular was showing that maybe wage growth wasn't there or the number of jobs weren't there. But the market, looking ahead, is not going along with the Fed continuing to aggressively cut rates. The market is still pricing lower interest rates in the future, but not nearly as low as they were pricing back in September. Why is that? Well, it looks as though the economy is doing better. It looks as though inflation maybe isn't going to go back to zero or below 2%. So that's the market's view. That's how it's priced. And the Fed cut rates this week, interestingly enough, is that didn't even warrant a mention. For so many years, it seems, we've lived and died on what the Fed's going to do. This week, with the election happening, just overpowered everything else, and the market was expecting virtually 100% that the Fed would cut a quarter. It was like a total non-event. So anyway, Jimmy, the Fed cut rates back then, and since then, both the short end and the long end have risen in terms of yields.
The U.S. dollar's had its biggest monthly gain in October in over 2 years, and it's kept rising following the election. Will that rally in the U.S. dollar continue? For me, because I love to trade currencies, that is the $64 zillion question. The dollar it's been trading sideways in a rather narrow range for about 18 months or so. Let's see, earlier this summer, the expectation in the FX market was that the Fed would be cutting more aggressively than the ECB, and that put a bid in the euro. And when the euro is rising, most other currencies will kind of also tag along with the euro. It's just such a big factor in the FX market. But that certainly all changed, and certainly since the Fed did the interest rate cut in the middle of September, and just shortly after that, the U.S. dollar just started to rise as interest rate expectations changed, and the dollar index that we look at, which is a blend of European currencies, Japanese yen, and Canadian dollars, basically, but heavily weighted to European. The U.S. dollar index has risen 4.5% or so. Will it continue? It's not always just about interest rates. You've heard me say once, maybe too many times, capital comes to America for safety and opportunity. There's American exceptionalism. You've heard that term. That's in the air. The American stock market has just so outperformed the rest of the world. It's like the rest of the world doesn't even matter. I'll be putting up a chart this week about what the market cap of stocks are, but for the American stock markets, both the major ones and the not so big ones,
represent about 55% of the market capitalization of stock markets all over the world. And American stocks have just gone up much more than anybody else. So that draws capital. Will it keep going? I think, we've heard that Trump wants a weaker dollar. Well, maybe the other way around. What he wants is some of the countries that have a mercantilist trade policy, he wants to see their currencies rise. You got to think particularly some of the Asian markets, and the Asian markets all need to stay competitive with each other when they're trying to export into the United States. If they're doing that with a cheap currency, it's easier for people to go, holy mackerel, this is a deal, when they go down to the local store and, buy something made in Asia. So Trump thinks, and he's got some merit to this idea, that those Asian currencies are artificially low, and he'd like to see them higher to make it tougher for them to compete into the American market. Jimmy, I've traded currencies for the better part of 50 years. I have a couple of expressions. One of them is that trends go way further than you think makes any sense, and then they turn on a dime and go the other way. So I don't know. I don't try to trade off of where I think the dollar is going to be a year from now. And that I'll just kind of go. If I find it's maybe overdone one way or the other, I might try to trade a reversal. But generally, I'm going to go with the trend, and the trend's up.
The Canadian dollar's trading around 4-year lows. Why is that? And will it keep plummeting? Falling or slipping?
Remember the Canadian peso? We used to talk about that.
62 cents.
So why is it? Of course, there's more than one reason, but something that is just like the deer in the headlights. American interest rates are substantially higher than Canadian interest rates. Like across the curve from short end of the market out to the long end, it's about 110 basis points. And that is a drag. Now, I could say, just be a smartass, I could say, well, the Canadian dollar is falling because Justin Trudeau. Okay, and that would be that. I can't imagine what will happen the first time Justin Trudeau meets Donald Trump. I imagine he will be, if he's got any sense, he'll probably be shaking and anticipating that Trump will probably be rude to him. Why wouldn't he? But it's not just that. Canada has this special relationship with the United States, but our dollar is lower because, like the rest of the world, America or the opportunities in America, whether it's on interest rates or the stock market, they've got a tech sector in their stock market that we don't have. We've got other things, hewers of wood and drawers of water and all of that. We may be a fabulous source. We're producing, for energy, I should say, 5 million barrels of a day. Great place to buy uranium, any number of other things. But right now, the trend is U.S. dollar bullish. And the interest rate spread between Canada and the United States just makes it that much tougher for the Canadian to go up. Now, before I say that's that, I do trade the Canada a lot. And I tell you right now, the speculators in the futures market are hugely short of the Canadian dollar, just like they were back at, when was that, the beginning of August? That would be about right. And the Canadian dollar rallied then as those guys were covering their short positions. They got to go in and buy back, so that I think there could be an opportunity here just from a positioning point of view. The market's already, the speculators particularly, aggressively short Canada. If for some reason the Canadian dollar starts to rise, those people covering their short position could give us a kick to the upside.
Gold hit record highs in late October, but was down $150 at this week's lows. Is the bull market over?
I don't think so. I think the gold market has had a hell of a run. Just over a year ago, last October, before the Hamas attacked Israel, the gold market was substantially lower. Where were we at? About $1,800 or something, $1,900 in October of last year. So we've had about a 50% run, and it's not just in the year, but the gold market's really had a great run to the upside. Why has been gold going up? Well, we know the central banks have been big buyers. There's been thoughts about, if you get on the wrong side of the United States, they might freeze you out of the monetary system or something, or you don't want to have all your assets tied up in U.S. Treasuries. So people maybe the central banks want to diversify for that reason. Central banks and sovereign wealth funds. And then, just the fear and trembling every day that puts a bid into the gold market. And then momentum. Just like the Canadian dollar, the speculators have been aggressively short. On the gold, they've been aggressively long. So I think the market got ahead of itself with the futures market here trading above $2,800 in late October. And yeah, we came off $150, about 5% or so. And I think that was some of that speculators that were so aggressively long that maybe over-levered and had to liquidate some of their positions. I don't think the sell-off or the correction, let's call it that, is over. We'll see. I think this week in particular, the gold market has historically been sensitive and sort of traded with a negative correlation to interest rates in the U.S. dollar. For the last year or so, that hasn't been the story. And it was like something else has been driving the gold market other than the U.S. dollar and interest rates. And, of course, we came up with the answer of central banks. But I think this week, with the U.S. dollar surging and the stock market surging, maybe it's like, who wants to own gold? Just go buy stocks. And with interest rates rising, I think that kind of triggered a few sell stops in the gold market. So that's a part of the reason we sold off this week. But is the bull market over? I mean, I've been trading gold, Jimmy, since it was $100 back in the mid-'70s. So, no, this has been a long bull market. It's had some ups and downs.
In the energy markets, WTI hit a high of around $95 in September, and has trended, that was September last year, it's trended lower since then, touching a low of around $65 this September. Natural gas prices just a little above 20-year lows. What are your thoughts there?
Yeah, the energy markets, well, WTI in particular, where we go to up to about $130 when the Russians invaded Ukraine, and in a big picture sense, it's trended lower since then. It's very much a supply-demand story. Just very recently, the OPEC group came out once again and said they're going to postpone the production increases that they had said they were going to initiate. Remember, they had cut back their production to try to support the prices. If there's less oil around, the prices won't fall. But oil has been struggling. I know speculators have been less long than they have usually been over the past few years, so that maybe paints a picture. I mean, the Americans on what they call a barrel of oil equivalent or something like that are producing 20 million barrels a day. The United States is a net exporter. Natural gas is cheap like borscht in North America, although it's a hell of a lot more expensive in Europe or Asia, and that's why these LNG terminals or export terminals are getting built so we can make that arbitrage. But energy's just there's just enough of it around, I guess, when you get right down to it. China's economy is clearly not as robust as it was, say, 2 years ago. And the sanctions to try to keep Russian oil from getting out to the world have been ineffective, at the least. So, I think we've got at a big picture level, we've got a supply-demand imbalance on crude, and with the natural gas, we've got an arbitrage issue. If you could pipe natural gas out of the Permian to Holland, it'd be worth a hell of a lot more. But when you got to freeze it and put it in a boat and lug it over there, you can still make a profit on the arbitrage. But I think the bullish thing for natural gas may be that it looks like at the maybe very early stages here that production is declining in the United States, maybe as a result of the low price, or maybe some of the prolific fields are starting to run a little low in terms of what they can get out of them. Whatever. I follow the energy markets. I trade it occasionally, but I'm not as focused there as I am on the stocks, interest rates, and currencies.
Before we wrap up, do you think we've entered a new era with Trump winning the election? And if so, how will that affect your trading?
Well, I think absolutely we've entered a new era. And with Trump, you just never know. I think the markets will probably have to price in a little more volatility than they would otherwise if somebody else was president, because of Trump's kind of, it seems, mercurial nature. You know, he'll say something dramatic, you know, at a drop of a hat, or tweet something dramatic at 3:00 in the morning his time. You know, you just never know where you're at with Trump. But how's it going to affect my trading? I'm not sure that it'll change much. I mean, I'm always trying to be alert for what's happening, not, you know, and as a good friend of mine says, trade the markets the way you think they will go, not the way you think they should go, you know. So, yeah, I'll just continue to look for opportunities. I'll pay attention to how markets are positioned. And, Jimmy, as I've said so many times, you know, I make money on balance, not because I've got a fabulous crystal ball and I know what's going to happen. It's just I'm really, really disciplined about risk management. So what that means is when I'm wrong, I'm gone. Just, this isn't working, get out, and I'm try to stay with things that are working. So, you know, I don't mean to be flip, but yes, it's a new regime with Trump there, and the markets will change. They're always changing. But my approach just to look for opportunities and make sure, you know, I try not to just trade on intuition or impulse, I should say. Intuition I will trade on. But, yeah, look for opportunities, and you know, if it's not working, take a small loss, and it's suddenly history, and now I get a clean slate in front of me.
Victor, thank you so much for being on This Week in Money.
Jim, it is always a pleasure to talk with you. Thank you for having me on.
My guest has been Victor Adair. He was speaking to us from Parksville on beautiful Vancouver Island. His website, victoradair.ca. Coming up, Robert Campbell, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. You can find it online at realestatetiming.com. He's speaking to us from San Diego. Bob, welcome back to This Week in Money.
Hi.
When's the next Campbell Real Estate Timing Letter coming out?
It's coming out November 15th.
Can you tell us about your book, Timing the Real Estate Market, and where people can get it?
Yes, I wrote that book in 2002, and because of my experience in real estate, I've been around the real estate development business the whole time, and the cycles, you know, how when they're good, when they're bad. And so I decided to look at what indicators I could follow to help me predict where the cycles were, you know, which way the trends were going to go. And I wrote a book about it. And I did a lot of research. I researched 25 different variables going back, like, 30 to 50 years. And I knew what the cycles were because, you know, me and my family had lived with them our whole life. And I went back and saw, which of the indicators I looked at had predictive value, identified 5 of them, and wrote a book about it. And I still use those 5 key indicators today to help me make predictions. I've added a few that, you know, because I've learned a lot in the last 23 years, but that's still those 5 that I identified, they worked back then and they still work today.
Stock markets hit new all-time highs this week following President Trump's election win. What do you think the win will mean for stock markets, the U.S. and the world?
I think the stock, I think there's a good chance. I don't know. I can't follow. I can't predict the stock market like I can the real estate market. But I think there's a good chance that the stock market can keep going up and up, And that's because I doubt we're going to have a recession anytime soon, with the government spending $2 to $3 trillion more than it takes in. So I mean that added demand going, it's very stimulating to the economy. Real estate, however, I think operates on a different cycle, and even though it can keep going up because of inflation, at least hold its own against inflation, it is super overvalued now by the indicators that I follow. So it is just ripe for a correction. I mean, this real estate boom was 20% more extreme than the last real estate boom, and that ended in 2006. And nationally in the United States, housing prices fell, I think it was 35%, and in California they fell 50%. So there's no reason that same scenario won't occur this time, because this isn't the first cycle. You go back to the 1970s, 50 years ago, and you can see the cycles. They go up, they go down. They go up, they go down. And that's just, and real estate's very, very cyclical. And so you got to count on that. There's no reason that the cycle's not going to continue.
Are mortgage rates in the U.S. increasing?
Yeah, they're increasing right now. And that's what's interesting about that. The mortgage rates fell down to the almost 6%. About when was it? Let me tell you I think it was just like 2 or 3 months ago. And then the Fed cut interest rates, the Fed funds rate, by half. And since then they've gone straight up. They've almost gone up to 7%. So so now with which is very, very bad for the housing market, because not only were we were at almost record low unaffordability levels, prior to that cut in the Fed funds rate, and now since then, since the Fed cut rates, mortgage rates went up a point, not down like everybody thought they would do. So housing is going to become even more unaffordable. And the reason I'm focusing on unaffordability, guys, is this, and it's just all based on charts. You want to find out what's going to happen in the past, go look at a chart, look at something you're looking at and say, okay, and look at the major turning points and say, what happened prior to these turning points? And that's what I did when I wrote my book, and you look at a bunch of variables, and you can see, and affordability is a big factor when it comes to when the cycles turn, because housing markets only get so unaffordable, and then maybe it's just an act of God. That's when they turn. They don't turn when housing markets are affordable. That's not when the cycle turns. It's when they get highly unaffordable. And so that's where we are now. So with the increase in mortgage rates, that means that the mortgage payments are going to be even more expensive than they were like 3 months ago. And incomes aren't increasing like crazy, that fast. So they're going to become even more affordable. And so we're getting closer to the end. And the turn's going to come. My guess would be based on prevailing trends, probably 6 to 9 months. Then the cycle will turn from up to down in the United States, and then after that, housing prices based on previous cycles and projections on reversion to the mean. I think U.S. housing prices are going to drop probably 30%, and California's are going to drop 40%.
The Fed cut rates again this week by 1/4 point. Is that going to help mortgage rates? Because it doesn't seem to be doing the job so far.
Well, we're going to see. I doubt it. Here's what's happening, guys. Wow. It's just the opposite what you think is happening. Because the Fed's cutting rates, not because they should be cutting rates, but they're cutting rates for the sake of the economy and the sake of the election. That's why they did it, to try to keep the incumbent in office. But what the market has spooked that out, and they said, okay, we can see what the Fed's doing right now. They're cutting rates, and with all this deficit spending that's going on, which is highly inflationary, that's going to push, naturally, if just left alone, rates would go up. And so that's what people are anticipating. That's why they're selling off the long bonds. They think inflation is going to come back. The bond market speaking, with their money. These are people just opining about things. Bond market has taken a real crash in the last 90 days after the Fed cut rates.
Is it true home sales are at 14-year lows in the U.S.?
Yes, 14-year lows. They just hit 14-year lows. And normally, one of my key market timing indicators, my number one predictive tool is existing home sales, because it's a pure measure of demand. And so when demand falls off, what do housing prices do? They fall off with it, supply and demand. This time, however, prices they didn't do that because supply became super restrictive. When the mortgage rates got down to in the twos, a lot of people refinanced, in the mid to low twos, and they're sitting there now. Now rates are at 7, and they're going, I can't afford to sell. Why would I sell? I mean, where am I going to move to? I'm not going to move up. It costs me a fortune. So those people are just sitting there, and that restricted supply on the market, but that supply is slowly starting to come back in because of things like death, divorce, retirement. You get moved. You have to sell your house. You want to sell your house. Pretty soon, everybody's, that life events occur. And many of those life events ultimately result in the sale of a house, and it doesn't matter what the interest rate is on it. So it's slowly going back to normal right now, and it's going to get back to normal because things always do, and that's when the cycle's going to turn.
Is the inventory of homes for sale increasing?
Absolutely, and that's what I'm focused on right now. I'm no longer focused on existing home sales, because that's not predicting anything, because supply isn't figured into it. So now I'm including supply in the key indicators that I've looked at, and it's been that's a really, really good predictor too. You go back and look at inventory, how it goes up and down, and includes supply with it. It's very predictive, and I didn't know that 23 years ago, but I know it now, because I'm trying to explain why the markets are doing what they're doing. And from a standpoint that on page 10 of my timing letter, I put a bull or bear on the final page, my final words. Bull means prices are going up. Bear means prices are going down. I still have a bull in the market, even though we're super overvalued. Super overvalued, and because even with crashing home sales, because supply hasn't kept up. But it's starting to catch up gradually, and that's when the turn will come. There'll be price cuts, and price cuts beg at future price cuts, and now the psychology of a bear market takes over, where housing goes from being highly unaffordable to affordable again, and that's when the cycle turns up. It's a very key indicator to watch, guys. And I only know one other person in the world that focuses on that indicator, but I sure locked into it about 5 years ago because I looked at the long-term track record, and it's a very, very key indicator to watch because timing's everything. Timing is always everything.
Is President Trump's win likely to make homes more expensive or more affordable?
Well, I don't think he's going to have any effect on it at all. The only way you could make the only way you can make houses more affordable is to drop the price. Yeah, knock the price down by 40%, and probably we'd have a lot more existing home sales. He's not going to do that. He can't control that into the market where he would, allow prices to fall. He can allow them to fall, which they probably will fall. But so, I don't know how we can stop it from happening. Only way you can stop it from happening is, give everybody, a free gift of a 20% down payment, and make the qualifying reasons requirements for a loan less stringent. But is that going to help the cycles in the long run? No, it's just going to make it worse. One thing I've learned is nothing is permanent in this world, Jim. Nothing. It's all subject to change. Sometimes there's really big changes. Sometimes, like a real estate cycle, because most of the cycles here in the United States, or especially in California, are 3 years, 6 years up, 6 years down. And you go look at that cycle, I can show you a graph, and you go, wow, That's pretty remarkable. You go, yeah, did that just happen by coincidence? No, because there's 4 cycles that precedes the one we're in right now, where that what I'm telling you is going to happen has already happened. So it's a really, really high bet. But you just look at the charts and you go, wow. If change didn't occur, Rome would rule the world, Jim, and they don't. 700. They only made a go of it for 700 years. Then they fell apart. So everything ends in this world, and then there's a new beginning. And the people that are best able to identify those major turning points like that, and then position themselves at least so that hopefully to make money and not lose it. Those are the people that financially are the most successful. I said Warren Buffett's really good at that.
What's the latest on California home sales and prices?
California home sales and prices, the home prices are still going up, but the rate at which they are going up has declined. So maybe like a year ago they were going up at 5%. Now they're going up at 3%. And sales are kind of holding their own, but there's no big downtrend anymore. I mean, it's still in a downtrend. But one thing that California has right now is that inventories slowly starting to creep back into the market. And when you compare, and when inventory starts increasing more than sales, see right now, so we have sales going down and inventory going up. Okay, with those two dynamics, it's only a matter of time until the cycle turns. And those are the trends we have right now, guys. So I'm just not imagining this stuff, and just coming out with some wild projection about what's going to happen. It's all based on supply and demand. I mean, which is the only rule of economics that has any value. So it's all based on that, and it's based on looking at the past and seeing how well some of those key indicators like inventory, existing home sales, building permits, et cetera, how well they've forecasted major changes in the market. And they really have a great track record, guys. So that's why I can say that's a huge advantage to have, and to use it for your own account. Like, what's the best time to buy a house? I mean, even if you want to live in it, from a financial standpoint, is now the best time to buy a house? No, not at all. How confident, how sure of you are saying that? I'm very sure of that. Because the time to buy a house is when prices are low. In fact, what I suggest for people getting ahead in this world, the best investment you'll ever make in your life is wait for a downturn in home prices during the down cycle. Use what you can to identify when the bottom of the market is in. Buy a home with a lot of leverage. Let's just use an 80% loan. Okay, or you put 10% down, you get a 90% loan. Okay, now you get a 90% loan at an interest rate which is usually low because the market's depressed. It's lower than it was at the peak, so the market's depressed, and so you have a low interest rate for 90% of the value of your home for 30 years. Not only are you going to get the benefit of appreciation in a rising price market, but also that 30-year loan you took out at a low interest rate relative to inflation, you're going to pay that loan back, and you want to stay in that house a long time. You're going to pay that loan back with dollars that are really worth 50 cents. That's a big deal, guys. Because the rate is fixed, but inflation's going off. So every year that loan relative to inflation becomes less and less valuable. I mean, you may get you might put $10,000 down, get a $100,000, $90,000 mortgage, and then and that represents 30% of your income when you bought the home. At the end of 10 years, 20 years, whatever number you want to choose, pretty soon now you have a $60,000 loan or $70,000 loan, and you're making more than that in income because of inflation. So in other words, you don't want to own that mortgage in an inflationary market. You don't, on a long-term basis. But that home, yes. And pretty soon you're paying off that mortgage with cheaper and cheaper and cheaper dollars all the time. And how strongly do I believe that inflation will continue to be a problem? Very strongly, because because I know it's built into the economics. So that's what you teach your kids, folks. You help your kids like that. That's how you get them started. You buy low and you get a big mortgage, assuming they can afford the house, and then just ride the wave, ride the price wave, ride the depreciation wave, with inflation, and you got everything going for you, and you have a home you can live in, that makes you feel more secure. You can raise a family in, you can fix up and do whatever you want to do with it, and that's the best investment you'll ever make in your life.
How are the other areas of the U.S. doing with home sales and prices?
Well, in general, I think home sales in the United States are nationally are down like 20% year over year. And I think that, overall, existing home sales are a 14-year low. That's nationally. That means they're depressed. I mean, some areas there hasn't been a big turn in the prices anywhere where you're seeing anything, like 20, 30% yet, because supply is still restricted. But some areas in Texas, for example, like Austin, Texas, I understand their prices are down, 15, 20% from the peak, somewhere in there. I mean, that was a boom town. Supply's coming back in. And, that's one of the worst examples. I mean, there's some places in Florida where the condo market has just got nailed, where, prices fell like, a third because that they couldn't get insurance because of the hurricane risk. And if you can't get insurance, all of a sudden nobody's going to buy a house and all the insurance risks. So there's always something, guys. You just can't focus on one thing. You have to look at the market as a whole. What's going on? And does anything last forever? No. So there's going to be a turn. Yes. I mean, based on previous cycles, is this turn likely to be, a small correction or a large correction? Large. Is that something you're comfortable handling at this point in your life, wherever your life is? Yes or no? If the answer is yes, no, you can't handle it, you got to get out. And if yes, I can't handle it, I'm 70 years old, I'm going to die in this house, I don't care what the prices do, sure, and you can afford to live there, just stay in it. But if you bought your house a year or two ago and you're talking to somebody like me and you think the forecast can be that California housing prices will likely drop around 40%, is that something you want to stick with? No. You got to get out of that. You got to get away from it. It's going to bankrupt you. I mean, that's the nature of things. Not everybody that buys real estate gets rich. If that was the case, Warren Buffett, he'd own a hell of a lot more real estate than he does, and he owns very little. So it's that you can win and you can lose with real estate, and especially with the leverage, that magnifies both ends. When you got the wind at your back, the leverage helps like crazy. When it's in your face, it can bankrupt you.
Are we likely to see lower energy prices with President Trump back in office?
I am not so sure. Because and I know what Trump's saying. We're going to become energy independent again. Yes, and I believe he brought us to that level. At least, if you believe, you got to believe something. And it appears that the problem is that U.S. energy doesn't have oil fields like the Middle East, like Saudi Arabia, where you can just, somebody can put a blindfold on you, walk you out in the desert, and you stick a 200-foot straw in the ground and oil starts gushing out. In the United States, most of our oil comes from fracking right now, as I understand. That's where we're going to get the increase in production, is from fracking. Also, we get it from ocean drilling. That's expensive oil, guys. That's not cheap oil. So yeah, can we become energy independent where we say, okay, we don't need Saudi Arabia, we don't need Russia, we don't need Venezuela. That if need be, we can produce all the oil we need on our own. Yes. Is that going to be cheap oil? No, it's not. It's going to be expensive oil.
Is inflation going to continue to rise or fall?
I think inflation is going to keep going up. And I say that, the reason I say that, it's not because I had a dream last night. It's because if you look at the cause of inflation, it's caused by the government running deficits. And we're running record deficits right now. And we're going to continue running record deficits as far as the eye can see. until we stop this madness of, spending more money than we make. But as long as the U.S. spends, I think the national debt in the U.S. went up $3 trillion last year. Okay, and then they say, the national, it showed the deficit as only being $1.6 trillion. Okay, I don't believe the $1.6 trillion. I mean, the only reason the national debt went up $3 trillion is because the U.S. spent $3 trillion more than it brought in. Because you don't borrow money and then don't buy anything. So the real litmus test of how deeply we're going in debt relative to the fact that we can't cover the expense with tax revenues is the national debt. Just look at it, and it's going up $3 trillion. It's going up, $1 trillion every 3 to 4 months right now, and I don't see how that's going to stop. That's built into the system. That's what we need. The government needs to keep spending 50% more than it takes in order to keep the wheels on the car in the United States. Because they have Elon Musk that's going to step in, and I said, as government efficiency, and I know this is true. He said, how much do you think you could cut out of the national budget? And he goes, $2 trillion. I think they only spend like 6 or 7, so that means, and the government is, 20 to 25% of the total workforce. Unemployment would go crazy. All those government workers would be out of work, and the economic downturn would be incredible if he did that. I mean, so short run, it would be a panic. I mean, that we'd be in a 1929 type of thing, because 25% of the people are unemployed because we shut down government operation. But the thing is, I mean, would that be a long-term solution to the problem? 100%. So in other words, long-term gain, short-term pain. And most people aren't willing to put up with that. Back in the, I think it was the 1920, 1921 recession that we had in the United States, it was after World War I. It was a terrible downturn. I mean, really bad. And the government just stepped away and didn't try to save everybody, save everybody from disaster by throwing money at it. So there was a lot of people that got hurt real badly. Unemployment went way up. People lost their businesses. But after all that cleansing was done, the U.S., now it was like a year and a half later, the year and a half experienced record growth because you got rid of the dead wood. And all of a sudden, once it was gone, and all of a sudden people were doing things that they thought were important again. And, the GDP just went crazy, and it was an economic boom after that collapse in the economy. So if the government stays away, is everything going to get really bad for a year and a half or so, 2 years? Yeah. But that's, sometimes that's what you need to do to fix the problem. But, otherwise you go, oh, we can't let them go broke. Oh, we can't let the banks go broke. Oh, and the car companies, we can't let them go broke. In fact, we're not going to let anybody go broke. We're going to bail out everybody. That all that means is when the system eventually does collapse, it's going to be that much worse. So that's why I'm a free market economist. Just stay away. And everything will sort itself out. That things are automatic. A downturn automatically leads to an upturn. A boom automatically leads to a bust for a variety of reasons. So, it's not the Fed or the Treasury or the U.S. government saying all these failing businesses are too big to fail. All that does is postpone the inevitable turn a little longer, and when it happens, it's going to be that much worse.
Could gold have peaked for at least a while in late October?
Gold went down 3% yesterday after the presidential election. And why? If you look at a year chart of gold, it's, prior to yesterday, it was up 30% in the last year. Well, after yesterday, it was only up 27%. So why did gold take that 3% down, which is a relatively big drop in the price of gold? And my only explanation is because Trump said he's going to lower inflation, which is wrong. And then gold, because gold tends to be can be very correlated with inflation, like it is now. And so people said, well, gold's going to go down. Well, today gold's back up. I think it recovered like 1 or 1.5%. So do I think the bull market's over in gold? No. I think the bull market, it will continue, and it's going to continue for a long, long time, for 2 reasons. One, inflation, the deficits, and the second reason is people don't trust the government. And who's buying the gold right now? Is it Joe Sixpack and his wife, the average American? No, it's world central banks. So who knows why they're doing this? I mean, these people have a lot of power, what they do. And all of a sudden, they might use the gold to like back their currency. You know, the U.S. dollar's unbacked. The BRICS nations to say, okay, we have a currency we're all going to share, or even individually, the Chinese yuan or the Russian ruble. They have enough gold. I know Russia does to back their currency with 20-30% gold. That's huge. So if you want to buy a currency, what currency would you buy? Would you buy the U.S. dollar that's unbacked? It's just the faith of the U.S. government, what they're doing right now, which most people have no trust in, as evidenced by the election results a day ago. Or would you rather put it in a currency that is backed by gold? The ruble, the gold-backed currencies would become the powerful currencies in the world. So I think gold's going to a much higher level. I think world governments know this, that you just can't keep printing dollars that you can't cover with tax receipts, forever and ever and ever, and still have people to accept the fact that there's value in the dollar. That value can turn real quickly. Where people go, I don't want the dollar anymore. I want the Russian ruble. It's backed by gold. I'll take that. And so you sell your dollars and buy rubles. Dollars down, rubles up. So I think gold is ultimately going to play a very key role in the long term in making the world a better place.
Housing market, correction versus crash. What could we see ahead?
Well, I mean, so my forecast based on previous cycles and the principle of reversion to the mean is that, California, nationally, U.S. housing prices are going to drop, in the range of 30%, California 40%. I mean, I call that a crash. A correction is like, 10 or 15% or 5%? It ain't going to be no correction. And even if it is a correction, even if it does, people say, oh yeah, there hasn't been a house sold on my block, for years, but I know my home hasn't gone down in value. Yeah, that's because of inflation. It hasn't gone down in value. But if you look at that, if you adjust for inflation, okay, your house went up 5% last year, but inflation went up 10%. Your house is losing value because it's all about purchasing power of the currency. Doesn't matter how much your house is worth. I don't care if your house is, whatever it is. It's that because it all what gives your house value is when you sell it and get money. What can I buy with that money? Could I buy more or less with that money today than I could 5 years ago? And if the answer's no, you can't, then you sell your home because you got to protect the purchasing power of your money. You have to do it. I mean, look, and that's why inflation is much greater than the government is telling you. It's much greater. I mean, you can't believe any of that data because it's very self-serving for the government. To say that, oh yeah, we got inflation down to 2.5%. And if you ask 100 people randomly in the United States, what's your biggest problem right now financially in the United States? The majority of them would say inflation. They can't afford the price. And is the 2.5%, inflationary price increase any more than it was, when Bernanke had it at 2 or below? No. So in other words, the number's false. It's a phony number. Because you wouldn't have 40% of all Americans say that inflation is their number one financial problem. If it wasn't, that's a big number, and that's another reason why Trump won the election.
How important is it to have ambition?
Ambition. I think it is extremely important to have ambition because, and this is like when you're young. Hopefully you have ambition then. But just using myself as an example, when I was younger, in my 20s and 30s, and got out of college and started working and investing money and doing all that, I had a lot of ambition. I wanted to own the most expensive home on the tallest hill in San Diego County with the biggest ocean view. And I said, I'm going to do that by the time I'm 45 years old and retire. Well, life intervened in there a couple ways, a couple of divorces, business downturns and all of that. But the fact now that I'm way beyond that and I'm looking to do things, I said, okay, because that's what keeps you young. That's what keeps you vibrant. That's what keeps your brain working. Now, fast forward 40 or 50 years, now what do I want to do? Ambitiously. I mean, do I want to make more money? No, not really. Is that my highest priority? No. Highest priority is health, number one. But making money isn't it. I've got enough money. My wife and I have enough money to live comfortably. We don't need to be driving around in a new Lambo every year. So we have enough money. So what do you do, though, as far as ambition, to keep pushing that? I'm going to play in an over 65 softball league. Over 65. I know how to play baseball. I'm really fit, and I can play in that game. And I'm doing a little rehab work to do that. But that's my ambition is to be the best softball player in San Diego County that's over 65 years old. I doubt I will be, but I want to be up there where I'm like the best player on the team. That's my ambition. Because all of a sudden you strive for something like that, guys. It's so healthy to do that. So healthy. I mean, one, you got to be physically fit to perform at a high level, whatever you do. But to keep looking ahead, and I call that ambition. I'm not going to become, change professions at my age. Not going to do that. But obviously, you want to do things like that. Also ambitious that I need to write a second book because I've doubled or tripled my knowledge from what I know about real estate timing compared to my first book. I have to write that second book. I have to do it. And so those two things, and writing my timing letter. I will keep writing my timing letter. And unless you are physically and mentally fit and can stay sharp, there's no way I can do all those things. There's no way I could write a timing letter if I was like the average American. So in other words, when you retire, that if you just want to go lay on your couch and wait for the phone to ring to babysit your grandkids, you're not going to be healthy, and I doubt you're going to live the life that you could live.
Where can people follow you, buy your book, Timing the Real Estate Market, and subscribe to your newsletter?
Go to my website, realestatetiming.com, just like it sounds.
Bob, thank you so much for being on This Week in Money.
You're welcome, Jim.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter, and his website is realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Robert Campbell. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.